So many big question marks hanging over bond markets globally. Connect the dots for me between U.S. Treasuries, the 10 years up, about 320 right now, and we've got a Federal Reserve, regardless of what the markets expect about the Fed saying, oh, we don't have to be so aggressive. In 2023, the median dot is, something like 3.7%, and the highest dot, maybe Jim Bullard, is 4.4%. What does that mean for bond yields globally if the Fed remains aggressive and U.S. yields continue to rise as the Fed's willing to put up with?
I think what we have seen so far is that the bond market experienced quite a lot of volatility as we try to handicap the different dynamic going on in the growth and the inflation picture. We term that in our cyclical outlook as the anti-Goldilocks. So growth is running too close to zero. We have the GDP now from the Atlanta Fed, at somewhere between 0 to 0.5% for second quarter. Meanwhile, the inflation picture is certainly looking like it's staying quite elevated. So how the Fed would react in that manner, how much more rate hikes can they deliver? They have stated quite a strong intention to keep inflation under check, and so the market has priced in a lot more rate hikes compared to just a few months ago. I think around the world, central banks are also reacting to what the Fed might do and also what the domestic inflation situation is. And there is a big range of how these different countries are reacting to it. So there are some opportunities to be captured from those divergence.
Where do you see one of the top opportunities in divergence? We talk a lot about U.S. and China. If you're not looking at China, who else is on your radar screen?
First of all, I think on China, we have been more constructive at the beginning of the year, but now that they've outperformed so much, it is a place where we see maybe the yields could actually track up a bit from here, despite some of the easier monetary policy from the PBOC. There might also be increased issuance coming from government issuance on the fiscal side in terms of stimulus, and on top, you could also see some capital flow movement from there. Within Asia, we have seen certain central banks being less aggressive to those that are much more aggressive. So Korea has been on the more aggressive end. Australia is also more perhaps being expected to hike quite a bit more and similar to the U.S. And the other end of the spectrum, you might have Bank of Thailand that might be going a little slower. And in addition, you also get China, which I just described as perhaps easing on the margin, but could be utilizing more on the fiscal side than the monetary.
We've seen high-yield dollar China bonds really not seeing a winning week since about April. Do you see further pressure and further divergence there?
So on the there's been a big divergence on high yield and investment grade in Asia. On the high yield side, it is correlated to the general risk appetite, global credit spread movement, and also worry about some of the general liquidity condition, in addition to some of the more specific sectoral impact from the likes of China property. So valuations are kind of ratcheting to a very cheap level, but the fundamental side, we still need to wait for a turnaround, especially from China macro. We have seen lockdowns periodically over the last few months, some more severe lockdowns in the Shanghai and Beijing area, and that has gotten growth expectation lower, gotten less confidence and animal spirit in the economy, and so the high yield bonds are reacting to that phenomenon.
Where else do you see dislocations and therefore opportunities? You're saying keep a higher cash allocation at the moment to be able to have that flexibility.
I think we're just seeing quite exaggerated moves. Volatilities are very high across different markets. We are looking through and seeing which market has priced in more in terms of, let's say, recession odds. And one of the things that we picked up is on looking through, the equity market and looking through the currency market and looking through the bond market overall. And depending on your odds about recession, bonds are starting to look quite interesting So yields have gone up a lot. So the starting yield now from this point onwards is at a more attractive level, despite some of the inflationary concern. And it's starting to be at a level where it could kind of act as a hedge from other risk-off type of movement. And we're also seeing inflation-linked bonds having corrected quite a lot, and now with real yields all in the positive territory, and you also get adjusted for CPI in your coupon payout, so that could be a reasonable hedge as well.